Vietnam ended the second quarter of 2026 with stronger than expected GDP growth of 8.4%, well ahead of expectations, despite challenging external environment. Investors were concerned that tensions in the Middle East could disrupt energy supplies and weigh on economic activity. However, those risks proved far more manageable than initially feared. Vietnam secured alternative energy supplies through active diplomacy, while domestic measures, including the nationwide rollout of E10 gasoline, helped cushion the short-term impact. Growth remained broad-based. Industrial sector continued to lead the economy with 10.5% growth, supported by strong manufacturing output and ongoing construction activity. Services maintained healthy momentum at 7.9%, while agriculture delivered another stable quarter, highlighting the resilience across all major sectors of the economy. Overall, Vietnam posted first half 2026 GDP growth of 8.2%. Inflation also moved in a more favorable direction. Headline CPI eased to 4.7%, helped by lower global oil prices, which pushed gasoline and airfares down by more than 10% during the month. While housing, construction materials, and food prices remained elevated, overall inflation pressures appear to be moderating, providing a more supportive backdrop for both consumers and businesses. Domestic demand continued to strengthen as well. Retail sales accelerated to 12.9%, suggesting that recent policy measures aimed at supporting consumption are beginning to gain traction. Even after adjusting for inflation, real retail sales grew 7.3%, indicating healthy underlying consumer demand. Tourism remained another bright spot, with international arrivals reaching 12.2 million in the first 6 months of the year, up nearly 15% from a year earlier. Investment activity also remained robust. Vietnam's FDI disbursements hit $13 billion in first half, up over 11% year-on-year. This isn't by chance, it's location, a young workforce, and deliberate government effort combined. Proof point. On July 2nd, Vietnam and EFTA Switzerland, Norway, Iceland, Liechtenstein concluded FTA talks, bringing Vietnam's network to 18 agreements, among the most extensive in Southeast Asia. And the investment itself is getting more strategic. LG Innotek is expanding semiconductor substrate manufacturing in Haiphong, key components linking chips to devices. It lines up with a new Politburo Resolution 10 calling for a shift from just attracting FDI to building national capability, raising localization, and upgrading Vietnam's own firms in the process. Public investment also continued to gather pace, growing 12.9%. Faster land clearance and more efficient compensation procedures are helping remove one of the country's longest-standing infrastructure bottlenecks. While the government's proposal to raise the fiscal deficit ceiling for the next 5-year period signals a strong commitment to accelerating infrastructure development. Meanwhile, manufacturing activity remained in expansion territory, with the PMI easing modestly to 51.8, while inflationary pressures on both input and output costs continued to soften. The trade deficit widened to $16.5 billion, driven largely by higher import costs for energy and semiconductor components, as concerns over global chip shortages and rising prices prompted companies to front-load purchases and build up inventory. We expect the deficit to narrow through the second half as these imported inputs flow through to shipped output alongside typical seasonal export acceleration. Finally, despite the temporary trade deficit, the Vietnamese dong has remained broadly stable against the US dollar. Continued FDI inflows and relatively attractive domestic interest rates have supported the currency, while foreign exchange reserves increased by around $4 billion year-to-date to $87.6 billion. Although reserve levels remain below the IMF's recommended 3-month import cover, the recent improvements suggest that current policy measures, including tighter controls on gold smuggling, are beginning to produce tangible results. The VN Index gained a modest 0.3% during the month, with performance largely driven by a handful of heavyweight stocks, while broader market participation remained relatively subdued. Market sentiment improved in the second half of June, supported by easing geopolitical concerns following positive developments in the US-Iran negotiations, as well as MSCI recognition of Vietnam's continued progress in capital market reforms. Even so, investors remained cautious. Average daily trading value declined by 24% month-on-month to around $761 million USD, while foreign investors continued to reduce exposure, recording net outflows of nearly $583 million USD during the month and more than $3.1 billion USD year-to-date. Looking at sector performance, financials and real estate were the key outperformers. Banking stocks benefited after the State Bank of Vietnam raised the cap on short-term funding that banks can use for medium and long-term lending from 30% to 40%, effective July 1st. The policy should help ease funding pressure and improve balance sheet flexibility across the sector. Meanwhile, gains in real estate were concentrated in Vingroup-related companies after the group was selected as the EPC contractor for 5 new metro lines in Hanoi. While the news boosted share prices, we believe investors should remain mindful that execution capability and project financing will ultimately determine the long-term value creation. On the other hand, energy was the weakest performing sector. As tensions in the Middle East eased, oil prices retreated, reversing much of the earlier rally in oil-related stocks. Finally, MSCI kept Vietnam in the frontier market category in its 2026 review, a decision that was widely expected. While full market reclassification will take more time, the reform process continues to move in the right direction. Progress on key initiatives, including the central counterparty mechanism, English language disclosure, and account registration, is encouraging. Foreign ownership limits remain an obstacle, but we believe the government is gradually addressing this through state divestments and new IPO, which should expand the investable free float over time. Given this steady progress, we continue to expect Vietnam to be added to the MSCI Emerging Markets watch list in June 2027. In June, the portfolio's net asset value increased by 0.8%, while the reference index, the FTSE Vietnam Index, decreased by 0.6%. Year-to-date, the portfolio declined by 2.4%, while the reference index rose by 1.9%. Looking ahead, we expect the market in the second half of the year to become increasingly earnings-driven. Despite delivering solid earnings growth, many companies have seen limited share price appreciation as investors remain cautious amid global geopolitical uncertainty. With geopolitical tensions now easing and Vietnam's macroeconomic data posted stronger than expected results, we believe market sentiment is likely to improve. The upcoming second quarter earnings season, which begins next month, should provide an important catalyst. We expect strong corporate results to help re-rate fundamentally attractive, high-growth companies beyond the index heavyweights, allowing their share prices to better reflect underlying earnings momentum. In addition, the first phase of Vietnam's inclusion in the FTSE Secondary Emerging Market Index is scheduled to begin in around 3 months, providing another supportive tailwind for the market. Valuations also remain compelling. Excluding Vingroup-related companies, the top 100 listed stocks are currently trading at just 11 times our 2026 forward earnings estimate. In our view, this offers an attractive entry point for investors seeking exposure to Vietnam's long-term structural growth story.